Ever wondered how you can maximize your tax return? Let's dive into the world of tax planning. It's more than just paperwork and deadlines, it's an opportunity to save money and increase your tax return. Tax planning is all about understanding the tax laws and using them to your advantage. It's about making informed decisions that could potentially save you hundreds or even thousands of dollars. This video is your guide to tax-efficient strategies. It's here to demystify the complex world of taxes, showing you how deductions, credits, retirement contributions, and investment optimizations can work in your favor. We'll break down these concepts, providing you with expert advice so you can navigate your tax return with confidence and ease. Remember, tax planning isn't a one-size-fits-all approach. It's a personalized strategy that adapts to your financial situation. So, stay tuned because with the right strategies, you can unlock the secrets to maximizing your tax return. First, let's dive into one of the most crucial aspects of tax planning: deductions. Now, what are tax deductions? In essence, tax deductions are qualifying expenses that you can subtract from your taxable income. This means that they work to lower your overall tax bill by reducing the amount of your income that is subject to tax. Think of the process as a math equation. If you begin with your total income and then subtract these deductions, you're left with your taxable income. The less taxable income you have, the less tax you owe. Simple, isn't it? So what kinds of expenses qualify as tax deductions? Well, there's a wide array. Common examples include student loan interest, mortgage interest, and medical expenses. Let's take a closer look at these. If you're paying off student loans, the interest you're paying can often be deducted. This provides a bit of relief for those grappling with the burden of education debt. Mortgage interest is another big one. If you own a home and are paying a mortgage, the interest you pay on that loan can usually be deducted. This can be a significant amount, especially in the early years of a mortgage when the majority of your payments are going toward interest. Medical expenses can also be deducted, but there's a catch. Only the amount that exceeds 7.5% of your adjusted gross income can be deducted. So if you had a particularly unhealthy year, this could potentially offer some solace. Now, the key to maximizing these deductions is to accurately track and report these expenses. Keep meticulous records, and don't be afraid to seek professional help if you're unsure. It's always better to be safe than sorry when dealing with the tax man. And remember, every deduction, no matter how small, can add up to big savings. So don't overlook anything. Remember, every deduction counts when it comes to reducing your taxable income. Moving on, have you been taking full advantage of tax credits? Now let's dive deeper into the realm of tax credits. To start with, what exactly is a tax credit? Unlike tax deductions which reduce the amount of your income that's subject to tax credits are a dollar-for-dollar reduction of the tax you owe. In other words, they directly lower your tax bill. Now, there are a plethora of tax credits out there, but let's focus on some of the most common ones that may apply to you. First up is the child tax credit. If you have children under the age of 17, you might be eligible for a credit of up to $2,000 per child. This can be a significant boost to your tax return. Next, we have education credits. If you, your spouse, or your dependents are pursuing higher education, you may qualify for one of two credits: the American Opportunity Credit and the Lifetime Learning Credit. These credits can cover a portion of your tuition and related expenses, lightening your financial burden. Then, there's the Earned Income Tax Credit. It's a refundable credit designed to support low to moderate income working individuals and families, especially those with children. The amount of this credit varies depending on your income, filing status, and number of children. Now, while these are some of the most common tax credits, there are many more out there. It's worth exploring all the available options, as every little bit can help lower your overall tax bill. Remember, the goal here isn't just to pay your taxes, but to do so in the most efficient manner possible. And tax credits play a crucial role in that. They're not just reductions or refunds, they're opportunities. Opportunities to invest in your children's future, to further your education, to support your family. Tax credits can be a powerful tool in your tax planning strategy, so make sure to claim all the credits you're eligible for. Because at the end of the day, it's not about how much you earn, but how much you keep. Next, let's talk about a long-term strategy: maximizing your retirement contributions. When it comes to tax planning, perhaps one of the most potent strategies is contributing to your retirement accounts. These contributions can significantly reduce your taxable income, which in turn lowers your tax bill. But how does this work? Let's break it down. There are two types of contributions you can make to your retirement accounts: pre-tax and post-tax contributions. Pre-tax contributions are made before your income is taxed. This means that the money you contribute is deducted from your income before your tax is calculated, thereby reducing the amount of income you have to pay taxes on. On the other hand, post-tax contributions are made after your income is taxed. While this doesn't reduce your taxable income in the current year, the key benefit here is that the withdrawals during retirement are generally tax-free. So you pay the taxes now to save on taxes later. Now, different types of retirement accounts have different rules for contributions. For instance, in a traditional 401(k) or a traditional IRA, your contributions are pre-tax, reducing your taxable income for the year you contribute. But with a Roth 401(k) or Roth IRA, your contributions are post-tax, and the withdrawals during retirement are generally tax-free. It's also important to note that there are limits to how much you can contribute to these accounts each year. For example, in 2024, the contribution limit for a 401(k) is $19,500 if you're under 50, and $26,000 if you're 50 or older. For an IRA, the limit is $6,000 or $7,000 if you're 50 or older. So, whether it's a traditional or a Roth account, contributing to your retirement can be a tax-efficient strategy. Not only does it help secure your future, but it also provides tax benefits that can help you save money now. Remember, investing in your future can also help you save on taxes today. Lastly, let's explore how you can optimize your investment taxes. Now, investments come in many forms: stocks, bonds, mutual funds, to name a few. Each type of investment carries its own unique tax implications. That's why it's crucial to understand how they work. Let's start with stocks. If you sell a stock for more than you paid for it, the profit you make is called a capital gain. Capital gains are taxed, but the rate depends on how long you've held the stock. If you've held it for less than a year, that's a short-term capital gain, and it's taxed at your ordinary income tax rate. If you've held the stock for more than a year, it's a long-term capital gain, and it's taxed at a lower rate. Bonds, on the other hand, can generate interest income, which is usually taxed at your ordinary income tax rate. Mutual funds, a pool of various investments, can result in capital gains, dividends, or interest income, each with its own tax considerations. So how can you minimize your investment taxes? One strategy is tax loss harvesting. This involves selling investments at a loss to offset capital gains elsewhere in your portfolio. It's a bit like turning lemons into lemonade. Yes, you've had a loss, but you can use that loss to reduce your tax bill. Another strategy is to hold your investments for longer to take advantage of the lower long-term capital gains tax rate. Remember, patience is a virtue, and in this case, it can save you money. Also, consider the tax efficiency of your investments. Some investments, like index funds and exchange-traded funds, are more tax efficient than others because they generate fewer taxable events. In conclusion, optimizing your investment taxes is all about understanding the tax implications of your investments and using strategies like tax loss harvesting and long-term holding to your advantage. With smart investment strategies, you can keep more of your hard-earned money. Now that we've covered these tax planning strategies, let's summarize what we've learned. We dove into the world of tax deductions, revealing how these can decrease your taxable income. We then unraveled the mystery of tax credits, showing you how they're a dollar-for-dollar reduction in your tax bill. Next, we explored maximizing retirement contributions. We discovered how contributing more to your retirement fund not only secures your future but also lowers your current taxable income. Lastly, we delved into the realm of investment tax optimization, highlighting how strategic planning can minimize the taxes on your investment gains. Each of these strategies holds the key to maximizing your tax return, providing you with more resources to invest in your future. Remember, tax planning is a year-round endeavor. So start implementing these strategies today to reap the benefits when tax season comes around. Don't forget to like, share, subscribe, and comment for more financial information content.